Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again John Rubino. John has been on this show a number of times in the past, and always welcome to have him. He runs an excellent website, a blog that I would encourage you to visit and partake of the many good articles that are there, some of which are John's and some of which belong to other people, but he shares the wealth, and we're very pleased to have him with us again. Thanks for joining us today, John.
Hey, Jay. Good to be back.
Now, it's dollarcollapse.com, isn't it, where people can go to catch up with your work?
It is, yeah. And
dollarcollapse.com.
Yeah, and it's a site that covers most of what we're going to talk about today on an ongoing basis.
Yeah, and we want to start out, Michael Oliver, who we had on, was just talking about some of the currencies, the dollar and so forth, and he thought a very real prospect here that the Fed may start to look towards zero or negative, or we have zero interest rates essentially, but negative interest rates. It just seems so insane to me, John, I just incomprehensible to me that we could be willingly going into negative interest rates. You wrote on an October 19th blog an article there, negative interest rates are here, and you noted not so long ago a bank was by definition a business that took deposits from customers and then lent them out and made money from those loans. But that's not how it's working, at least for the larger banks today. In fact, as you noted, at least some of these big banks are telling large American corporations that they don't really want their money anymore. They don't want their deposits. And how do you explain these actions from big banks? Why are they doing that?
Well, a couple of things have happened with big banks in the last few decades. One is that we removed the regulatory impediments to these guys growing into basically hedge funds.
Yeah.
So they're first of all, they're huge. And second of all, they can make more money now trading with each other. You know, they can write derivatives and trade currencies and manipulate various markets and make a lot more money than in boring old-style banking businesses like taking deposits and then lending the money out. The other thing is that post-2008-2009 crisis, the government has been shoveling newly created dollars onto the balance sheets of these big banks. And that's left these guys with really more ready cash than they know what to do with. So they're just redepositing that money with the Fed, earning a little tiny interest, but totally risk-free and with very little paperwork, presumably. And so that to them is more attractive than taking deposits and having to make sure tellers are being nice and heating and cooling the bank buildings. You know, the actual banking involves a lot of work.
Yeah.
And depositing your money at the Fed and booking a small, steady, risk-free interest stream requires almost no work. And the third factor now in big banks souring on big corporate deposits is that the regulators now treat large corporate deposits kind of as hot money, you know, something that can flow back out again as easily as it flowed in. Mm-hmm. And so they want the big banks to hold a lot of reserves, that is risk-free liquid assets, against those deposits, which makes the deposits less attractive for big banks. So add it all up, and there's no reason for JP Morgan Chase to go out and solicit deposits from big corporate customers because it doesn't do them any good. They don't make any money off of it, and it's a hassle. So they're charging fees now for companies that want to deposit money. And that's the first instance of a effectively negative interest rate in the U.S. because, in effect, they're charging negative interest if they charge a fee on a deposit.
Sure.
And so this is where it begins, but there's no doubt, or almost no doubt, that it spreads to the rest of the banking system in the next couple of years, because the U.S. is really alone in the world in talking about raising interest rates. Everybody else is cutting interest rates. And in some cases to negative levels. A big chunk of the European bond market now trades with negative yields. And a lot of European bank accounts now charge you for the privilege of holding onto your money. And so the fact that those economies are doing that, they have incredibly low interest rates, and they're still not growing. They're still drifting downward into recession in a lot of places, means that they're going to have to step it up and go to even more extreme policies to keep that drift downward to zero growth from turning into a plunge into dramatically negative deflationary growth. There's a real risk of the amount of debt that we've taken on causing a new 1930s style depression. And these guys know that, so they're leaning against it with every monetary tool they have. And so far it hasn't worked. That's what's really scary, that we've created all this new currency, we've cut interest rates to record low levels, and it hasn't produced a rip-roaring inflationary boom like it would have any other time in post-depression history. Mm-hmm. And so they're looking at new strategies from here, and all they've really got is more of the same. So, if zero interest rates didn't work, let's try negative 2% interest. And if a budget deficit of 7 or 8% of GDP didn't work, let's go to 10 or 12%. And that's what we're going to see going forward. It's completely uncharted territory and fascinating from a theoretical standpoint, but from terrifying from every other standpoint.
Well, I agree with you there. We've had inflation, of course, John, a lot of it in the financial markets, in the asset markets, and the housing prices in some markets, of course. But it's not getting out to the real economy. Is that why? So these banks are essentially operating a casino. They're playing in a casino world where they can move money around real fast, place their bets. And to heck with long-term growth, to heck with the long-term, stable, boring returns. Let's make as much money as fast as we can, and who cares about the real economy? Is that what's going on?
Largely, yeah. For a bank to lend money to some Main Street business where growth is minimal and the risk of failure is very high, is not nearly as attractive as having your trading desk place a bet and then having another part of your trading desk move the market in the direction of that bet and then booking a big profit that way. For the last couple of years, we've seen big banks like Goldman Sachs and JP Morgan Chase report whole months where their trading desks made money every single day. Yeah. And you can't do that in the real world in a competitive market. You can only do that if you're manipulating the market.
Manipulating the market.
One thing that's happening lately, though, Jay, is that has changed. The big banks can't make money as consistently with their prop trading desks as they used to be able to. And the reason for that is that we're hitting a really volatile stretch where the global financial system is so gorged on leverage and so unsure about what government policy is going to be going forward that you get these wild swings out there that are unmanageable, even for the big banks. And so they're having to actually trade based on their own opinions about what's going to happen in the world rather than their own manipulation of the world. And it's not working for them. The big banks are not making nearly as much money now as they did last year and the year before. And that's a new and different development.
John, I have to wonder to a certain extent also, a lot of these countries are trying to reduce their, cheapen their currency, debase their currency in essence to try to get some export advantages. Is that something that could spiral out of control as well and could take us into a competitive devaluation scenario? Is that something even that perhaps the Federal Reserve is concerned about? Maybe not wanting to raise interest rates because of what it might do to the dollar. Michael Oliver was just saying that more than he's heard in a long time, the Fed seems to be focused on the dollar. I can remember the Greenspan days when Greenspan and Bernanke too would say, well, we don't comment on the dollar. But apparently the Fed is now. Is this another potential threat to negative interest rates as well? Because countries are going to have to keep cheapening their currency?
Oh, yeah, because in effect, with the dollar going up while most other currencies are going down relative to the dollar, that means we're losing the currency war. When you think of it in those terms, because as the dollar goes up, it makes it harder for U.S. companies to sell stuff that they price in dollars to the rest of the world. So our export sector and our multinationals in general, every time they report quarterly earnings, they say, it wasn't as good as we thought it was going to be because of the strong dollar, and that's the thing that's holding back, or one of the things that's holding back growth in corporate sales and profits. And if corporations aren't making more and more money year after year, then how do you justify rising share prices? You know, a share of stock is just a share of ownership in a company, but if the company's making less and less money, then the price of that stock should go down. And so the chain reaction that the Fed is terrified of is a rising dollar because they raise interest rates or because they refrain from cutting interest rates. That hurts corporate profits, that in turn sends the stock market into a bear market, and which finally sets off some kind of a financial chain reaction around the world that the central banks can't control. You know, we're so leveraged and so fragile that we might not be able to handle a garden variety bear market. You know, 20% drop in the S&P 500, for instance, might be a systemically risky event. You know, that's the kind of thing that happens every 5 years and we get past it. But it might not be the case that we can get past the next one of these. So the Fed is actively watching all of this, and they're completely paralyzed because. Well,
I wonder to what extent they have control of it, John, because we're seeing a lot of weakness in the equity markets, except for some of the big names in the Nasdaq and a few of the the highly those names that have a huge amount of weight attached to the indexes. Are we think of Google and I don't know Amazon and some of those that have maybe Facebook and some of them that have done extremely well recently. And just a handful of those stocks can pull up the whole index. But it seems to me that the market is not nearly as good as it appears to be on the surface.
Well, yeah, big tech is an interesting story because when a technology's time comes, it really doesn't matter what the overall economy's like. That technology is going to grow. For instance, during the Great Depression, when most people couldn't buy much of anything beyond food, car sales still boomed because it was the auto industry's time. You know, they had the hottest new technology in the world, and enough people wanted it to allow them to grow dramatically. And the same thing is true of smartphones for Apple, or cloud computing for Amazon, or artificial intelligence for Google. You know, these things are going to be the dominant technologies of the coming decade, and the best makers of those technologies are going to grow like crazy. And that has nothing to do with the overall economy. It's that these technologies have just arrived and they've got to have their early run. But as you said, under the surface, the market is seeing a lot more turmoil than you would think just by looking at the indices. You know, and you've got companies just tanking right and left now. You know, short sellers are having a ball out there. Our friends Bill Lagner and Kevin Duffy over at Baring Asset Management have this long list of shorts that are down 20 or 30 or 40% in just the last few months, where they're just raking it in. But a lot of other hedge funds that are long these formerly hot names like IBM and Walmart and that the drug company whose name is escaping me right now, but has really tanked lately. A lot of these guys are getting crushed. And you're seeing big hedge funds close and other hedge funds that like David Einhorn's and Bill Ackman's funds, which very seldom have down years, having big down years. And that's a sign that under the surface, the stock market is not healthy. And it's also kind of reminiscent of 1999. Remember when the global economy was supported by the U.S. stock market, and the U.S. stock market was supported by about 20 big tech companies?
Absolutely.
And then when they went down, everything fell apart. Well, we're kind of back there again. Where,
it would seem so, and even in this massive growth for big IT, there has to be some limit, John, to that growth, I would imagine. So, you know, how much of that future growth is discounted in these share prices, I have no idea because I don't follow the market that closely. But in any event, you know, the conclusion of this article that you had posted on negative interest rates, it concluded with the following comment. It says, with the global economy slowing dramatically, led by plunging corporate profits, U.S. interest rates will have to fall in 2016. And cash will have to be marginalized or made obsolete in order to get rates down to where they have a stimulative effect. Well, I'm wondering, to what extent do lower rates have a stimulative effect? Because as you pointed out, it doesn't seem to be getting the money into the economy. It doesn't really seem to be doing much of anything. If anything, I see a slowing global economy in light of all this new money that's created by all these different central banks around the world. So that's one thing. Maybe comment on that. And then also, what are we consumers to do, especially if we get negative interest rates? What are we supposed to do? How are we supposed to protect ourselves and protect our wealth? I mean, already, because interest rates have been pushed way below any kind of equilibrium by the manipulators at the Fed, it's a redistribution of wealth from the people that save and are thrifty to the people that are reckless spenders. But first of all, what do you think is continually decreasing interest rates going to stimulate the economy? I mean, it doesn't seem to have been very effective. Now, agreed, if interest rates were to rise suddenly, it would probably throw us over the abyss. But what are your thoughts on that? Will continually declining interest rates lead to economic growth globally?
Well, that's a big debate going on in the economics profession right now, or at least the mainstream part of the economics profession, where you've got some Keynesians who say, well, we just haven't gone far enough yet. If we lower interest rates to 2 or 3%, negative 2 or 3%, then it will stimulate growth. It's just, Keynesian standard theory taken to a further logical extreme. And you've got some other guys saying, well, obviously, that hasn't worked so far because that money is getting clogged up in the banking system. There's not new cash being turned into new loans the way normally it is. So let's go a different route. Let's have governments run huge deficits, spend that money on infrastructure, or rebate it through tax cuts directly to people. So we have kind of a QE for the people thing. Yeah. And then they'll spend it and we'll get growth. Now, either one of those things, to you and me, Jay, sounds like a catastrophe.
It sure does. It sure does. But, because lost on this discussion from the Keynesians is the notion of malinvestment and the need to have savings and also to have price discovery for capital, which isn't allowed to happen with the Keynesian markets. And how can you have capitalism if capital is not allowed to be priced?
Yeah, that's exactly the problem that we're looking at now is that, we're directing lots of new money out into the system, but the entrepreneurs and the executives who would normally put that money to work using price signals in their market are finding out that the price signals don't work anymore. So they're kind of flying blind. And so you're seeing all kinds of stuff happen out there. Like China is the best example of this, where they directed $15 trillion into an infrastructure build-out in the last 5 years. Politically, where local politicians would decide, hey, I want a new shopping mall over here and a new airport over there. And so, not surprisingly, a lot of those things are empty now. And they're not generating the cash flow necessary to pay off the debt. So China's in kind of a debt crisis here. And so the QE for the people, negative interest rate world approach would end up with an entire global economy in that same boat, I think.
Yeah.
And it wouldn't work, but it might work for like a year or two where it pumps up the financial markets a little more. And that would buy time, but only to borrow more money and leverage ourselves even more highly. So it wouldn't work in the long run.
Right. So to the extent that average people can put some money in the market, but the problem is, John, if we get some sort of a sudden turn to the downside, then people are caught again losing tons of money in the equity market. So I guess the question is, what are consumers to do in this environment? What are we to do given the cards that we're dealt here with these Keynesian economists messing things up so drastically?
Well, the government is saying, stop saving and start borrowing and spending. Right? Because we'll lend you money at next to nothing and we won't pay you anything for your savings. So go out there, buy that new car, buy that new house, buy stocks on margin. And that's almost certainly really, really bad advice. Almost any time, but now more than ever because we're so close to the end of a long cycle. And for someone who doesn't want to do that, there aren't a whole lot of really good options because you put your money in the bank and it just sits there and pretty soon it's going to be penalized for being in the bank. They'll take your money away. You invest in the stock market, you take excessive risks that might blow up on you with your retirement savings. And I've been saying for years that precious metals is the place to go to hide out. And for the last few years, it hasn't really worked. So I'm reluctant to tell people to jump into gold and silver right now. But there will come a time when there's an entry point when, looking back on it, you'll say, that's where I should have jumped in. I should have mortgaged my house and bought gold and silver. And I don't know when that time is. I don't know what.
Yeah, well, maybe not mortgage your house, but we had Roy Sabag of Gold Money, BitGold of the with the BitGold platform on this show a couple of weeks ago. Your good friend James Turk, of course, has joined with Roy Sabag. What are your thoughts about Gold Money, BitGold, and that combined effort there?
Well, I think it's a very interesting concept, but I'm also not qualified to speak to the technical aspects of setting up a gold-based currency. I would love to see how this plays out in the next few years and see how it's accepted in the marketplace and see how they handle rising growth technically and see how governments respond to this concept in terms of regulations. They're right now they're
Okay, well, we lost John. Unfortunately, we're just about out of time in any event. Sorry about that, folks, but maybe we'll get John and talk to him and get some feedback from John that I can pass along to you next week, because I know he is a good friend of James Turk, and he has given a lot of thought to BitGold and Gold Money, and so that is a PayPal sort of a system, but using gold rather than currency. So very interesting concept, and one that I'm very bullish on, both from an equity point of view, owning the stock, and also as an investor.